that joined the previous session. I think you noticed that there were a lot of questions. Sorry, do we have a question already?
Yes, we do.
Yeah. Oh, they just can't see
You
or
can
hear.
go ahead. Oh no, the hand
No, okay.
disappeared.
Maybe it was for a thumbs up. Just checking if you can see my screen underneath with 3.2.5.
Yes.
Yes, okay.
Yes.
Okay, perfect. Thank you. So from the previous session, I think you guys, for those of you that have joined and for those that haven't joined, just for your benefit, we ran out of time because it's quite a complex concept to understand the difference between the two inventory systems, and we had quite a lot of questions. So I'm hoping that if we could structure it, this is a suggestion, if you could allow me to please complete the periodic inventory system first, and then once we've gone through the theory of that, I would give 10-15 minutes for questions, and then we continue with the perpetual inventory system. Again, I have some questions at the end, and then should we have some time available, we can start on the depreciation, hopefully cover that. And if you have additional questions that we don't get to, then you can always email us those questions or type it in the chat and we'll try get back to you. So if we do it that way, then I'm hopeful that we might be able to get through all the information that we need to. All right, so if that's okay with everybody, then I will sort of pick up where we left off. Our main discussions, just as a recap for those that couldn't join the previous session, Antonetta is kindly, she makes the recordings available and there are announcements on the main site for that. But the main things we started with in the previous session was basically the comparison between the two inventory systems. For those of you that aren't familiar from the prior session, what I'm sharing is literally just learning unit 3 of your study guide. It's not additional slides or PowerPoint presentation, so you could follow along in your study guide. So we touched base on the main differences between the periodic and the perpetual inventory system. And one of the main things is that for the periodic system, we use the purchases account, whereas for the perpetual inventory system, we use the inventory account. And for the periodic system, we normally don't know what our cost of sales are until we perform a stock take. Whereas for the perpetual inventory system, we normally have a computerized accounting system that shows us our number of stock items as we go along and their costs. The periodic one is normally for a company that's less complex and it's more inexpensive, whereas the perpetual one is normally for fast moving goods, for example, Pick and Pay, Checkers, those type of things. We had a good question in the last session to ask why do they then perform stock takes, for example, Checkers and Pick and Pay, and then we just confirmed that usually they do that just to confirm the numbers which are already on the inventory system, as we might have theft or leakages or breakages. Right, so hopefully that just provides a small recap, but the recordings will be available for those of you that have not been able to watch it before. We went through one example the previous time, which basically just in a very short summary showed how we calculate our inventory, right? So how we have our purchases account and our sales account. I'm not sure if there are people that are not muted. I'm not sure if it's just me hearing the disturbances, but seems to be better now.
Lynn-Marie, I just muted everyone. I think there was
Okay.
someone.
Okay, thank you
Okay.
so much. I appreciate that.
Pleasure.
Okay, fine. So basically, we just had a bit of the journal entries to show how we treat our sales and how we treat our purchases, and we are picking up from there. So basically, it's a recording of end of year adjustments for the periodic inventory system. In a periodic inventory system, there are no entries accounted in the accounting records during the financial year for the cost of goods sold. So that's what we said for our cost of sales. For this periodic one, we normally only have our cost of sales after our stock take. So for this one, at the end of the financial year, when a physical inventory count is performed, the accounts inventory and cost of sales are adjusted. In this step-by-step example of the recording of the inventory of the entity started the financial year with 20,000, right? So this also came from our previous example where they said we have a closing inventory of the prior year or an opening inventory of this year of 20,000 Rand. So in our inventory account, we would have had an opening balance in our T account of 20,000 Rand. And at the end of the financial year, an inventory count was performed and the inventory at cost price to the value of 40,000 Rand was counted. So that was our inventory left at year end. After we had done our purchases, deducted our sales, those were our cost of inventory left. Therefore, at the end of the financial year, the following adjustments are processed. So here, so transfer to purchase of sales. So maybe we start in the purchases column. We have purchases for the year. We had purchases of 10,000 and 15,000, and this originates, I think, from the top example. So we had purchases for cash for 10,000 and purchases on credit for 15,000. So those were debited to our purchases account, making it more. And at the end of the year, we clear our purchases account to our cost of sales account in the periodic inventory system. So then we credit whatever, if we had more purchases here, then we would take all of that to cost of sales. In an instance where we maybe had purchase returns, so if we returned something that we purchased, some stock was faulty, we probably would have had a credit on the side for purchases returns, and the balance amount would have gone to cost of sales. So our journal to basically clear out our total purchases for the year to the cost of sales account is we are crediting our purchases account, which we see at the bottom, and we are debiting our cost of sales account. And so the above closing entries at the end of the financial year are in line with our formula, right? So we had this right in the beginning of the previous session. There was a small section here to illustrate how we go about getting our cost of inventory. So we said we've got our inventory at the beginning of the year, and then we add our cost price of inventory purchased, and we less our cost price of inventory at our stock count, and then we would get our amount. And they're just reiterating that, but showing you this in an example so that it falls into place a little bit more. So we've got our cost of sales is equal to our opening inventory plus our purchases minus whatever we counted on our inventory stock take count. And that would give us our total cost of sales amount. So they give us a further example here to say the inventory account reflects an amount of 20,000 and needs to be adjusted to the inventory count amount of 40,000. So that is the inventory left at year end. So currently our inventory account, as we saw at the top, only had an opening balance of 20,000, but we have to get our inventory account to agree with what our physical stock is that we counted, which is 40,000, and this is done in 2 steps. So the amount of 20,000 is cancelled, and how this is cancelled is we take the opening balance of our inventory to our cost of sales account. I know there's some questions, but if you can just give me a chance to finish the periodic, maybe just note down your question. You can leave your hand up, no problem, and then we'll get to you just after we've gone through the examples. So the inventory account, we then had our opening balance as we did at the top. We take out that complete opening balance to cost of sales, right? So we basically make our cost of sales more, decrease our inventory account, and then we then record our closing inventory as an adjustment of cost of sales. So our closing inventory, so what we said is we had an inventory account with an opening balance of 20,000, and we need to adjust that in some way to show our physical inventory count so that at year end, our closing balance of our inventory account would be 40,000 Rand. And the way to do that are in these steps. So we have our opening balance of inventory. We take that to cost of sales. So we take that out. So the balance after these 2 entries would be 0 because the debit equals the credit. And then we bring in our cost of sales, from cost of sales, our 40,000 inventory, and that is our closing balance, which in the next year becomes our opening balance. And then in our cost of sales account, we have a similar thing, right? So we said that we actually take all of our purchases for the year and we clear that to cost of sales. So that is brought here down here in our cost of sales account. We bring in our purchases. We also said that we clear our opening inventory to the cost of sales account. So that is brought into here. And then we have our inventory closing balance also to the cost of sales account, which is brought into here. So our balancing figure in our cost of sales T account, that gives us our cost of sales. So after the completion of the above entries, the cost of sales at year end is as follows, right? So your cost of sales is your 5,000. This is this balancing figure here. And that is made up of your opening inventory, which is this 20,000, your purchases, which is the 25,000, and minus your closing inventory, which is your 40,000. So now that we have gone through the examples thus far of the periodic inventory system, I'd like to open the floor. If we give ourselves maybe until 10:30 at the latest, maybe there's not as many questions because we did have quite a few in the previous session, and then we can continue with the perpetual. Are there any questions at this point in time?
Yes.
Yes, go ahead.
On example 3.1, page 10, the
Page 10.
yes,
Yeah.
yes,
Yes.
yes, the inventory on hand, which amounts to 40,000, highlighted
Yes.
in yellow,
Mm-hmm.
yes, is inside the cost of sales account.
So it also forms part of the cost of sales account. So what we do is once we do our physical inventory stock take, right, we ensure that in our inventory account, we now bringing the real amount of inventory counted, right? So we had an opening balance of inventory, and during our year, for any periodic inventory system, we don't adjust our inventory account at all during the year. Then at year end, we do a stock take, and we have to then adjust this account to reflect the correct closing balance at year end. So at year end, only after our stock take, or if you do stock takes at different frequencies, but I do think mostly in your modules, the stock take will be done at year end. So you've got your opening inventory and you take that out to cost of sales, but then you bring in your closing inventory count into inventory, and the reciprocal entry is cost of sales. So your assumption is correct. The closing inventory does go to cost of sales, but it also goes to our inventory account, so that our inventory accounts balance, which is our closing balance, forming our opening balance in the next period, equals the stock take, which is 40,000. But it also has to go to our cost of sales account, as we have to see what was our inventory at the beginning of the year, what did we add to it, what did we purchase, what is our closing inventory, so we can basically see what is left. So we had 45,000. If we take into account our opening inventory plus our purchases, what we were left with is 40,000, and thus we can deduce that our cost of sales is the difference between the two, being the 5,000. Does that make sense?
Yes, but the cost of sales ends up being 5,000.
Yes. And that is the difference between what we had as our inventory as opening plus whatever we purchased from the supplier. So say, for example, we had 10, what can we say? We had 10 boxes of tea. Then we purchased, another X amount of tea, and that should have been our tea at the end of the period if we didn't sell any tea at all. Then we do our stock take to determine what amount of tea we sold during the year, and the difference between what we would have expected on the shelf and what is our stock take, that becomes our cost of sales because that inventory has been sold.
Okay, but at the beginning of the example,
Mm-hmm.
It says that sales of 22,000, 26,000 were made. So the cost of sales would total to 46,000.
So there's a difference between sales and
I
cost of
mean
sales.
the total
Yeah,
sales. I mean,
yeah. So our
yes,
total sales, which is this T account here,
sales.
that is 46,000. That's correct. But our cost of sales is something different, right? Sales is what the person pays you and you've got into your till, but your cost of sales is what it actually costs you. And any business, if it's a good business, wants to make a profit, right? So our profit would be the difference again between our sales and our cost of sales. Does that make sense?
Yes. I still have some questions.
Yeah, go ahead.
Well, yes. So if we made sales amounting to 48,000, right? And our cost of sales is 5,000. That means we made a profit that is
3,000
43,000.
in this example.
That means yes. Okay. Can I like that means our markup was around like 860%.
Yeah, and what that could be a business that's, for example, services, right? I'm just giving an example, right? Remember, these are just examples to show you sort of the debits and the credits. It doesn't tell you what the business is. It doesn't tell you what they're selling, but there could be many reasons that a business could make such a big profit, right? So
Yes.
yes, it might sound exorbitant, but that is the truth in this example,
Okay.
right? So for example, if you've got a
Okay.
hairdresser,
Well,
right? Her skills are
yes.
in her hands, right? So she charges an amount, say, for a
Yes.
haircut, but she doesn't use any consumables, right? The person washes their hair at home. She doesn't even spray some hairspray on them. Literally, all she does is maybe blow dry their hair if they want that. But she uses her skills, right? Which doesn't cost any money. But if you had a product
Yes.
extensive thing, so for example, somebody bought a hamburger, your cost of sales would be substantially higher, right? Because everything that you give the customer, your lettuce, your tomato, your patty, your bun, those things are all cost of sales. So if something is such a higher markup, it could be a services industry, but there could be many others.
Okay. Can I because I have like other questions, but I don't want to jump the gun because you will take us through the
Perpetual,
entire unit. So yes. So can I keep my hand up because
of
I want
course.
to like refer to questions we'll go through later because my
Sure.
question will ultimately come as you go through go through the unit.
Yeah, I think that would be the most efficient.
Okay, thank you.
Okay, thank you. Any other questions?
Good morning, ma'am.
Good morning.
I'm just a bit confused. I was listening, but I'm still a bit confused with cost of sales because it is supposed to be 5,000, and the only way that I can understand that it's 25,000 in the General Journal 3 is if the opening balance was added to the 5,000.
So remember, this isn't the cost of sales account. This is a purchases account, right? So it might be a bit confusing, but the purchases account is cleared to the cost of sales account, right? So our cost of sales is still 5,000. However, how does the purchases form part of our cost of sales basically calculation? Because what is a T account? It's basically a calculation, right? Which they've broken down very nicely in the study guide to show you that your cost of sales is always equal to your inner periodic inventory system, is always equal to your opening inventory plus your purchases, which is the 25,000, right, coming from your purchases account.
Mhm.
So this isn't any, it's not cost of sales, right? This isn't your cost of sales being 25,000. It's the portion of purchases that you are taking to the cost of sales account to enable you to determine what your cost of sales is. So you need all three of these. You need your opening inventory, you need your purchases for the year, and you need your closing inventory for the year to be able to deduce what your cost of sales is, the 5,000.
I understand it, but I'm not that, I don't understand how where the 20,000 comes from.
This
That's
20,000?
the main thing that.
Okay.
The 20,000 in the
In blue.
25,000.
Okay, so let's maybe just retract a little bit here, right? So what they say in the example right at the beginning is that you've got opening inventory. So in your prior year end, your stock take had 20,000, right? That was your stock count. That was your closing amount in your inventory account in the prior year. Brought forward in your current year, that's your 20,000. So when the year end started, given this is the 31st of December year end, on 1 January, you had 20,000 worth of stock in your store, right? And to enable us to determine what our cost of sales is at year end, we always clear our inventory account to cost of sales. So the 20,000 is an opening balance of your inventory account, right? That is the stock you had
Mhm.
on hand from the prior year. You take that 20,000 to your cost of sales account because that is just how we calculate it, right? It's easier for you to understand the steps. You had, for example, onions in your store of 20,000 Rand. Then you
Mhm.
purchased some onions during the year of 25,000 Rand. You had two purchases as per this example. You had some purchases on cash, 10,000, and you had some purchases on credit for 15,000. Those purchases that you had made your stock more. And we also have to take that into account to make sure what our cost of sales amount is at the end of the year. So we've got all of our purchases and we clear that to the cost of sales account. Just as in our inventory account, we cleared our opening balance of inventory to the cost of sales account. So hence the 25,000 is coming from all the purchases that you made during the year to make your inventory more. And the inventory opening balance is what you had on hand at the beginning of the year. And your closing inventory is what you deduced from your stock take at the end of the year. So we always have our opening inventory plus our purchases minus our inventory. And the difference between these is how much you sold, right? So what is your cost of sales? What was the cost of the product sold during the year?
Okay, I understand now.
You do?
Thank
Okay.
you.
You're welcome. Any other questions?
Morning.
Hi, good morning.
Hello, madam.
Hi.
Uh, Okay, you can speak. Go ahead.
I think you are both polite. So just one of you just speak. Then.
Oh, let me start. Uh, mm, Miss, I was asking that is it not possible for you if you can draft the calculations and show us this amount was generated from this one and this amount was generated from this one using the information that we see above of
Mm,
opening.
I maybe I'm misunderstanding, and maybe the rest can say if they, maybe I'm missing the point. But this is really giving you the calculation, right? The study guide is doing all of this for you already. I don't know how I could do it better because it's literally saying this is your opening inventory, right? That's your opening inventory. This is your purchase this minus your closing inventory gives you a cost of sales, and it does the same at the top for us. But if you want me to reiterate a specific thing or something doesn't make sense, please let me know because in my opinion, your study guide is one of the best I've seen. And I think the lecturers went through grave detail to not only give you journal entries, but also T accounts and then break it down into the calculation. But if there's something that maybe I'm missing or something you want me to reiterate, I'm more than willing to do that.
No, I was just only asking that.
Yeah, but is there something here that doesn't make sense to you or that you don't see the calculation for?
Yes, the problem is that because some of amount, if we do it in our own and we get lost in the way.
Okay. Is it because the T accounts you don't know what is plus and minus? or I'm just trying to understand?
No, it's not about T account.
Okay. Can you? I'm trying to understand where the gap is. So if somebody can maybe put it
Yeah.
in different words for me, also much appreciated. I just yeah. So if you can try explain to me what you're not understanding here, then I can try reiterate that.
No, means as I was explaining that if we can, if is it not possible for you to draft it down? Maybe we can understand it better, but
Do
it's
you mean
fine.
to retype this inventory and put the amounts?
Come again?
Sorry, I'm not. I'm trying just to understand because I think I'm maybe not understanding properly what you are requesting. But do you mean for me to do the T accounts?
Yes.
But even though it's yeah. Okay, maybe yeah. If somebody else can also maybe just reiterate if this is something that they are struggling with the way that I'm showing it now, or just put it something in the chat if you're
Ma'am,
struggling. Yes.
Okay.
I'm Monin.
Morning.
I think I can try to explain
Yes.
because this is what I think try maybe ma'am can help us understand where ma'am gets the totals by just adding like arrows on this is from this and that is from that instead of in a written way, basically.
Okay.
And
We can
where ma'am gets
try.
the totals.
Okay, so we could do something. Um, let's see if this works, and then you can let me know if it works for you or not. Let's see if I delete that, but insert.
Morning.
Okay. Yeah, go ahead.
I just
Hi.
wanted to reiterate the point that two of the fellow students have made. I think it's a bit difficult for some people to follow along when you're scrolling up and down. So we aren't entirely sure where you're getting the totals from. So I think I would like maybe a breakdown or, um, for example, you stipulating yes, this is the inventory close, this is that, and then eventually a step by step as to how you get to the final point. Because I think the back and forth for some people is confusing.
Sure. I was just going back and forth for those that didn't join the session the previous time as we had, dealt with that part of it. But sure, I can try. Is then the unanimous that this T account is not understood? These T accounts here, the inventory and the cost of sales. No comment. If I can try understand what
Morning,
you
madam.
guys are struggling with. Hi. Yes. Go ahead.
How are you, madam?
Good. Thanks on yourself.
Good. I was asking if it's possible for you to kind of slow down because when you are a bit fast, some of us cannot really understand the things that you're showing us.
Sure. I will try slow down more.
Thank you, madam.
Yeah. Welcome. So this is difficult to get it from there. Yeah, I honestly think that the colors should also help you guys. Um, yeah, okay. So on a clear sheet, you want the calculation to be done. So you want the example to be done in T accounts. Is that what you're saying, Flora? Tavelo? And then I think my question is because we'll be running out of time again, but do you want me to redo these T accounts here? Or is this understood what we discussed on how to get to cost of sales? Or is somebody on the call still unclear on how we get our cost of sales amount?
It's a bit unclear, ma'am.
It's unclear on how we get the cost of sales amount. Okay, so let me try do inventory and cost of sales. I'm just not quite sure how to illustrate this to yourselves. Let me try maybe get a notepad or something that can work, although I'll just be literally redrawing the things in the study guide, but let's see if we can make it work. So I will try to do this example again, so that we also have to get to the perpetual inventory system. Let me see if I do it in Excel, if this will help. And after we've done one example, maybe you guys can say whether it works or it doesn't work, or if it helps you or doesn't help you. Okay, so let's do a trial. Something just doesn't want to work. And I'm not sure if you can see my Excel now, or you can still see the Word document.
Yes, we see it.
The Excel or the Word?
Excel.
The Excel. Okay, fantastic.
Excel.
Okay, great. Thank you. Let's see if this can just close the other one. Right. So if we go then to this example that we had, and maybe we do a snippet from here. Okay. So our information that we were given from the study guide is basically this, as well as that we did a stock take at year end, and we had 40,000 closing inventory. Right, so that's basically our information that we have, and then our T accounts that we would have in this example. Just do a few like this. Maybe just copy them. Okay, so our T accounts that we were looking at would be our inventory account. So we have a debit here, and our inventory increases on the debit side. And we have a credit account, and this is normally where it decreases. Then we would also have a purchases account. And where I'm getting this from, which accounts are in the study guide, it's ones we have just done. So purchases would also increase on the debit side, and it would decrease on the credit side. Yes. Then we would also have our sales account and our cost of sales account. So let's maybe do our cost of sales account. And we would have our sales account. So for our cost of sales account, this one we would increase on the debit side. And we would decrease it on credit side, and then we would have sales. So for sales, it's the opposite. We increase our sales on the credit side, and we decrease our sales on the debit side. Right. Okay. So then what we have in this example is they say that the business started with a financial year with 20,000 inventory on hand. It also specifically tells us that our year end is 31 December, right? And that stock take was also done at year end of 31 December. So we would have an opening balance of inventory that originated from the prior year, right? So this is our opening inventory, which is the number one given, and that would be our opening balance, and that would be on our date 1 January, whichever year it might be, which is the beginning of our financial year, and this would be balance, right? Your balance would be your opening inventory. Opening. So that would be our, we can make this a bit bigger, that would be our 20,000 Rand. Right, that would be our opening inventory that we bring in. Then they said we have inventory of 10,000 that was purchased for cash. Right, so we also said in our previous example, we normally have cash and creditors accounts, or trade and other payables. So I can add those here just to maybe just go back one step, cash and then trade and other payables. I think your description for that is slightly different than what I'm using here. Let me just get the correct Trade another receivables, trade another payables control account. Right. Okay, control account. So when we said that we purchased inventory for cash for 10,000, right? We would increase our inventory, and it was purchased on the 30th of April, right? So when we purchased our inventory on the 30th of April, as we went through in the study guide, we would increase our purchases, and we increase our purchases on the debit side. So here we would have cash, right? That's our contra account because we paid cash for it, and our purchases would increase with 10,000. Then how did we pay for those purchases? So it said that we purchased it for cash. So in cash, when we pay for something, our cash is decreased on our credit side. And for every entry, there must be an opposite entry. So for every debit, there must be a credit. So hence, our purchases, where they came from, is on the 30th of April, we funded our purchases from cash. So we made our cash less, and we would have we would have had an opening balance of cash here, but we don't deal with that in this example. But just as inventory has an opening balance, in cash you would also normally have a opening balance. I can just put in an amount here, although this is not given in the study guide. And I think in the Learning Unit 3, you will deal with that more closely. So would have had X amount of opening balance, and your contra account for your purchases would come in here. So basically you have a debit in your purchases account and you have a credit in your cash account. So that is our first part, how we purchase some of the inventory. Then we purchased inventory again on the 31st of May on credit, meaning that our purchases account again increases on the 31st of May, but this time it's on credit, right? This is a trade payable. Maybe I'll just put TP in here. Trade payable, and that amount that we purchased the inventory for is 15,000 as per the example. So we made our inventory more because on the debit side, our purchases in this case, because it's the periodic system, becomes more on the debit side, and we would have also increased, sorry, this is the wrong way around. Our trade and other payables increases on our credit side, because we owe the supplier the money. So if we don't pay for something cash and our cash isn't decreased, we increase our trade and other payables. So the amount that we would have to pay the supplier at a later point in time is then accounted for in our trade and other payables account. And the contra account is again purchases, similar to cash, but in this instance, we aren't paying for it right now. We will pay for it, but it's on account. So then we have our purchases, right? So we've got two purchases, 10,000 and 15,000. And we have our opening inventory, which is there. We also have inventory of 22,000 that was sold by the business for cash, right? So we increased our cash and we also increased our sales. So where we get that from, they say 22,000 was sold on the 30th of June for cash. So if our cash increases, it increases on the debit side, and this is on the 30th of June. 30th of June, this was sales.
Excuse me, ma'am.
Go ahead.
Yes. I don't have a question, but I am aware that you can't see hands. So that raised their hand, they number 2. That's why I see yes. Can they ask their question now? Because the point of this exercise is for people to point out issues as they see them. Because if we wait until you finish, I think it would be really hard to address.
Sure, go ahead with the question.
Okay, number 2 can go.
Perhaps, madam, people may have forgotten to lower their hands.
Okay. Is there any other questions?
Copy saying you can unmute. I think it may be all dance.
Okay, no worries. Then, okay. But if there is something, as you stated, it is good in this example to rather stop me than allow me to finish. Okay. So if we go where we left off, number 4, which is inventory of 22,000 was sold by the business on the 30th of June, right? For cash, our cash increased with sales on the 30th of June with 22,000 Rand. So this would be our one entry, making our cash more, and we would also increase our sales with our contra account of cash. And this amount is also 22,000. Then we have inventory of 26,000 that was sold but on credit. So as we have a trade and other payables account here, we also have a trade and other receivables account. So these are people that buy from you but don't pay immediately. And for trade and other receivables, our debit side increases it the more people buy from you, so the more sales that they generate or that you get, the more the debtors side increases. So your debtors balance becomes more. So if we go back to the example, it says inventory of 26,000 was sold by the business on the 31st of October. So if we look at our trade and other payable, sorry, our sales account on the 31st of October, there was sales, but these sales were not for cash. These sales were on credit, but I'm going to maybe rather say trade and other receivables account. And this amount was 26,000. So as we increased our sales, we also have to increase the amount that we will still receive from these people because they didn't pay us cash. They will pay us later. This was sales. Okay, and this amount is the 26,000, which is our trade and other receivables. Then we also said that in our year end, at the end of a year, we had a stock take, and there it was counted that we had 40,000 amount of inventory on hand at year end. And as the scenario correctly shows us, that in order for us to calculate our cost of sales, there are a few steps that we need to do, right? So if we calculate cost of sales calculation, we have to do a few things. Number one is we have to clear our opening inventory amount to cost of sales. So what would that look like here? We have an opening balance of inventory here, and at year end, once we've done our stock take, we take this full amount. Just showing the S there now, but I think you guys understand it. We take this full amount of inventory to cost of sales, right? So here we would say our contra account is cost of sales, and the full amount would be going to cost of sales. And on this side, we would also have 31 December, and we would have inventory amount here, but this is our opening balance of inventory amount, basically, that we clear to this account. Clear opening balance of inventory to this account, and we bring in the full 20,000. Right, so this is step one that we do. It doesn't really matter in which order you do the steps, as long as you complete all the steps. Number two is that we have to clear our purchases account to our cost of sales account. So number two is we have to clear our purchases account. So yes, go ahead.
Sorry, ma'am. I don't know. It's only me who's seeing this. My screen just freeze. I don't know what's happening. I don't see any work you are doing.
Thanks for raising that. Is that the same for other people?
Yes, ma'am.
For everybody?
Yes, ma'am.
Oh, ma'am.
No, ma'am.
No.
We
Right.
can
You
see
don't
everything.
No, we can see what's happening.
Oh,
It's probably just the speed in terms of maybe some people are not following, but I think the I can see everything that you're doing.
Okay, so for those of you that can't see, sometimes it works to leave the call and just rejoin again if the screen is
Yeah.
frozen. So yeah, maybe you can try do that. But the session is also kindly being recorded by Antoinette. Although it's not ideal, of course, but if you can maybe just leave and try join again, then maybe your screen will be unfrozen.
Okay, thanks, man.
Okay.
Ma'am, I just want to use this
Sorry, ma'am.
opportunity to ask
Yes,
a question.
of course.
When there's a sale, don't we have to decrease our inventory somehow on the T?
So on the, it's a good question. On the perpetual inventory system, which we are trying to get to, that is where we
Oh,
adjust our inventory account the whole time. But on the periodic system, we
periodic.
don't adjust our inventory. So I think I said before, if we look at periodic and we look periodic and we look at purchases, a way for me to remember it is I try to see that the P and the R go hand in hand for periodic and for purchases. So in this system, we don't adjust our inventory account. What we do is at the end of our year end, which we will do in this example, is we adjust our inventory account for whatever our closing inventory is. So we don't have an
Oh,
accurate, as the sale happens, we don't adjust our inventory account.
okay.
However,
And then
the perpetual we do.
we do. Okay, I get you. I understand. Thank you, ma'am. And then the last one, can you just explain for the last time why we are taking the opening balance under the cost of sales for calculations
Sorry, what did you say?
on the T account? On the T
Yes.
account,
Yeah.
I see we dropped also the
Can you
opening
just repeat it on the
balance,
T
the
account?
20,000 on the T account of the cost of sales,
Yes.
ma'am. Yeah,
Yes.
yeah,
Yes, I
just
hear
where
you.
you are. Yeah, why are we doing that?
Okay, so just to remember, cost of sales is seen similar to an expense account, right? And for all our, I'm not sure if everybody has the knowledge of this yet, but for all our expense accounts, we never have an opening balance of that expense, right? We clear all of our expenses of the prior year to our profit and loss account to show us what our business did. Then on the new financial year, any new expenses goes to our expense account or our cost of sales account. So the fact that I wrote here opening balance was just to show that we take our inventories opening balance to cost of sales. As when we calculate our cost of sales at year end, these are the steps we need to follow, right? As the study guide also gives us a bit of a formula, which is that our cost of sales equals our opening inventory plus any purchases that we have minus what our closing inventory is for the year. So when we come to our T account, we have to make sure that we bring in all of this in the equation into this account to give us what our cost of sales is at year end. So the reason why this is there as inventory, it's taking our opening inventory from our inventory account to cost of sales to allow us to be able to do this equation and get our cost of sales figure.
Thank you, ma'am. Understood. Thank you.
Yep, you're welcome. Any other questions? I'm just cognizant of our time as well.
Not a problem.
Eh?
Not a problem.
Madam,
Yes.
Why should I?
I didn't understand.
Sorry? Can somebody, just one person speak at a time?
Yeah, ma'am, I wanted to ask
Sophia and
about.
Hassan.
I think let me first mute everyone and then you can put up your hand again, sir.
Thanks, Antoinette.
Okay, sir, you can go ahead.
Yeah, I wanted to ask regarding number 4. I didn't understand it nicely.
Okay, so inventory sold for cash.
Yes.
Yes, okay. So we've got our sales account, right? And when we have any sale in our business, to show that our sales have increased, so any sale that we have in our sales account, we would bring into the T account on the credit side, making it more. And because the sale was for cash, we would be increasing our sales with the 22,000, and we would also be increasing our cash, what is in our bank, with 22,000. Does that help?
Oh, we are saying that when they're saying that we sold and we sold for cash, so we're going to put it for
In our
the T
bank.
for sales and the T for cash.
Correct.
Okay, thank you, madam.
Yes, you're welcome. Any other questions or can we continue? Okay. Then we also had our inventory sale of 26,000 on credit, right? So as you just kindly asked me to reiterate, we had the 22,000 which we sold for cash, and then we had 26,000. So again, increasing our sales, which we sold on credit for us, meaning that somebody else is a debtor for us and they won't pay us now for the sale, but we will receive the funds later. So we increase our trade and other receivables control account. We are making that more. And this is an asset to be received later, just as our cash is an asset that we've received now. Okay. Then Antoinette, please stop me if there's something, but I will just continue with the cost of sales calculation at year end, as I think this is our biggest understanding and stumbling block. So if we have cost of sales calculation at year end, we said we have to clear our opening inventory, and these steps that I'm writing here is merely to get you to this equation at the top, which is in your study guide a few times. So to get our cost of sales amount at year end, we've got our opening inventory and our purchases minus our closing inventory. So how do we get that all into our cost of sales T account? First of all, we have to clear our opening inventory amount to the cost of sales. So here is our opening inventory amount. We had a balance of 20,000 from the prior year, and we clear that to our cost of sales account. So we take any balance that we have in year and we take it to our cost of sales account. Then we have to clear out our purchases account, right? So we take all of our purchases for the year. In this case, it's the 25,000 that we can add up here. We take out that full 25,000 and we take this to our cost of sales account as per step 2. Right, so we would take that full amount of 25,000. And then we don't have any balance left here because we've taken out the full 25,000. We take this purchases here to our cost of sales account. This amount is at 25,000. So we can do this. Right, so now we've done step 1 and 2. We've cleared out our opening inventory amount of cost of sales, and we've also cleared out our purchases account. But what we also need to do is we need to bring in whatever amount we counted of stock for the end of the year. We also need to take that to our cost of sales account. And we do that in 2 steps. Number 1 is we have to make our inventory account equal to whatever our stock take is. So our financial records need to show what is in our store. So if we counted in our store 40,000 Rand, now in our closing inventory, we would expect So this is inventory from stock take. And this is the 40,000 that we counted. Right? And this is on 31 December again. And this amount, as we said, our third step here, because we said we have to deduct our closing inventory, is to take our closing inventory to the cost of sales account. Right. So here we debited our inventory from the stock take. We brought it in. We said this is our stock on hand. And our contra account on the 31 of December would be that this is inventory from stock take. Right, this is the 40,000. Then if we do a total year, and a total year, we see this side is 40,000, whereas this side is 45,000, meaning if we took our inventory opening balance plus our purchases for the year, we would expect at the end of the year our inventory to be 45,000. And then when we do our stock take at the end of the year, we see there's only 40,000 of inventory on hand. And so our balancing figure, which is our cost of sales, is the 5,000. And this 5,000 is our cost of sales. So if we look at this equation, we will see that we said we have to take our opening inventory, which was 20,000 from this account. Then we are adding our purchases for the year, which is our 25,000 from this account. And we have to deduct our 40,000, which is our closing inventory, which gives us 5,000 Rand cost of sales. Any questions on this, as we'll desperately need to move along?
There's a lot of thumbs up and hearts going on. I think those whose hands are up is the same people since the beginning. So I want to also suggest that we rather continue, and if there is any pressing questions, they can either send an email to the, or not email, but rather post a message on the eTutor group or send an email to us on the FAC 1503 email box. What do you think, Lynn Marie?
Yes, I think otherwise we won't, I don't think we'll ever finish inventory.
Yes.
So,
Thank
we
you.
can. Okay, thank you. Thanks for the suggestion. So please, for those that's still not clear, yeah, as Antoinette suggested, please either post on your eTutor group or reach out to the lecturers and we'll try and best assist you possible. So after a long-awaited portion, we've got the schematic representation of our perpetual inventory system. The perpetual inventory system, as we said before, is a continuous update of the inventory accounts. It's a real-time tracking of inventory levels. So as with the periodic inventory system, we saw that we only update our inventory account at year end. Whereas with the perpetual inventory system, it's the whole time. The disadvantages of the system is it's expensive to implement. It's time consuming to keep the detailed level records. And then the advantages is there's greater control over inventory. It provides real-time information that could aid in management decisions, making regarding purchases, discounts, returns. What they mean with this is, for example, you would know when to reorder goods at a more realistic time. You might also want
Ma'am,
to.
sincere apologies. Can you please project? I'm sorry.
Am I not showing? What am I showing?
No.
We can see your schematic presentation.
Yeah, that is
We
what I'm
can
showing.
see.
Yeah. Maybe if you can't see, I suggested
can
before, maybe
see.
you log out and back in. Okay, hopefully that will help
Thank
for
you.
you. You're welcome. So what this means here is other than knowing when to purchase inventory so that you still have on hand before you're out of stock, discounts could also help. So if you've got slow moving inventory, for example, that you need to make sure that you sell maybe has an expiry date or whatever the case may be, then you could know when to put in some discounts. And it could also help, once stock has been returned to you, you could understand why the returns are happening. So the perpetual inventory system in itself just gives a lot of more control over inventory and gives you more hands-on experience. It also reduces the need for physical inventory counts, so it eliminates that need. Although I think most people, as discussed before, would probably do an inventory count as just to make sure that what they've got in the system is actually what's on the floor as a control. So the closing inventory of the previous period, similar to the periodic system, would be your opening inventory in this period, right? Showing it here. And again, this that I'm going through is not meant to be the example or to understand completely. So please allow me to get through this work and to the example before we go to questions. Then we are recording inventory purchases in the inventory account. So that's the big difference here. Previously, we were recording the purchases of inventory in the purchases account, not in the inventory account. Whereas in this system, as and when we purchase inventory, we are adding it to the inventory account. And then we are recognizing revenue sales and cost of sales as the sales takes place. So again, we are showing the cost of sales in our inventory account as we go along, and that gives us our closing balance at year end. So this again is not meant to be the only example you'll get. It's just breaking down what we see in the T account here. So we will say here, for example, we've got cash transactions where we are making our inventory more. So if we purchased inventory and we'll be decreasing our bank, I'm not going to do T accounts for this because we'll get to the examples. This is just to give you a high level overview, and we'll be reiterating this in an example. Then we've got our cash transactions, right? So this is when you purchased inventory, you would make your inventory more and you would make your bank less. And then the opposite is true. When you get cash in, you increase your bank and you also increase your sales. There's also credit transactions, so similar to what we did for the periodic one. When you increase your inventory but you don't pay cash now, you'll pay cash later. You debit your inventory account and you credit your trade and other payables. And then you have your recognition of cost of sales, meaning that once you've got this in, you are debiting your cost of sales account and crediting your inventory. This will make more sense once we go through the example. Credit transactions, so if you sell on credit, you would be debiting your trade receivables, similar to what we did with the periodic system, and you would be crediting your sales. Then we've got inventory valuation methods. When a trading entity purchases an inventory item, the price paid at the beginning of the financial year might not be the same price that we pay for later. So we know this all as consumers. What a break costs you now might not be the same price a break costs you in April or May or June, and that is the same for the companies that purchase inventory. Those inventory prices might go up or down during the different periods. So not all inventory goods that is sold by the end of the year for the trading entity need to, so not all inventory goods is sold by the end of the financial year. So if there's still stock on hand at the end of your year that you haven't sold, the trading inventory will need to place a value, a monetary value on this inventory still on hand at year end. And then this is very important. The valuation method used by the trading entity to determine the cost of the inventory and therefore the cost of sales should be the one that brings the most realistic determination of profit. So this depends on each entity, which of these two valuation methods they use. We will also explain what the weighted average method does, but in FAC 1503, you will only be tested on the FIFO method of inventory valuation, and we'll do an example to explain that in more detail. So in a nutshell, what it's saying is that when we have inventory on hand that was not sold during the year, we need to be able to give a value to that inventory. And there are two ways, two valuation methods. There's the first in, first out method. And according to this method, the items that were purchased first is considered to be sold first. It might not be that way, right? You might have on your shelf items of a similar nature. So, for example, canned goods, and you can't determine which one the consumer takes first. But in your accounting records, when you're looking at the costing, you're always assuming that the stock purchased first is the stock sold first. And this will make more sense in example 3.2. The inventory on hand is therefore valued at the latest prices. So we are saying that if the stock that we purchased first is sold first, then the stock that we purchased last would still be on hand. There's also another method for valuation, which is the weighted average method. And according to this method, the total cost of goods on hand is divided by the number of units available for the sale in order to determine an average cost per unit. So again, this doesn't fall within the scope of this module. But what they are saying there is, for example, if you had 100 units, so it says the total cost of the goods on hand. So say, for example, you had 100 units left at year end, but you paid 1,000 Rand for that. You would divide how much ever you paid for the units divided by the units remaining. But you don't need to understand that for this module. It's just to give you a better indication of that there is a different valuation model for inventory. So without further ado, I will move to the illustration of the movement of inventory units for the perpetual inventory system, right? We are not looking at the periodic system. We're looking now at the perpetual one that changes continuously the whole time, where we don't use a purchases account and where we debit and credit our inventory account as we go along. So if an entity keeps very detailed accounting records of the inventory on hand, then each receipt of goods is recorded and each sale of inventory is recorded, right? And we go into this table to explain. So the following table illustrates the movement in inventory for a month for one type of inventory. And the table works like this. It shows you all of these are water pumps, all of these transactions. It has the different dates that transactions occurred, and there is inventory received. So this is when we purchased things, and there's inventory sold. This is when we sold things. And then the following table shows how to cost the inventory using the perpetual inventory system. And please ensure that we only use the first in, first out method, which means that we assume that items purchased first are sold first. And inventory on hand is therefore valued at the latest prices. And this example will explain it in more detail. So at the top, they said we received inventory, meaning we purchased inventory, 10 items, 10 water pumps at 1,000 Rand, right? And here it does it for us. It says our cost was 10 times 1,000. So we had inventory received for that amount. Our units of inventory on hand is 10, and our balance, our cash balance in our inventory account is the 10,000. Then on the 3rd of February, we sold 5 units of this inventory. So the inventory sold is 5 units, whereas we'd shown previously the inventory purchased was 10 units. And then the inventory on hand would be what did we have, right? The units on hand that we had minus what we sold. So it would be 5 units left. And because we've only had one purchases, the full 5 units are calculated at the purchase price, the only purchase price we've seen so far. So then our balance would be how much inventory do we have left? We had 10,000. We sold 5 units at 1,000 Rand each. And so our balance that is left in the inventory account is 5,000. So we had 10,000 minus the 5,000, giving us a balance of 5,000. Then we had more purchases, but this time it wasn't purchased at 1,000. There was 8 water pumps purchased, 8 units purchased for 1,100 Rand. So now our inventory that we have on hand, because it's the perpetual inventory system that continuously updates the records, we had 5 before this transaction started, right? This is our units on hand was 5. Now we added 8, which we purchased, which it breaks down here. We had 5, we add our 8, now we have 13. The trick comes in though, is that our cost, which we paid for this 8, we know is 8 units times 1,100 gives us our 8,800. But our balance in our inventory account is that we had 5 units to start with, and these units cost was our original cost, 5,000. So hence our inventory balance is 5,000 times 1,000, as we assume that the inventory purchased first is sold first, and then we purchased another 8 units at 1,100. So this together gives us our 13,800 Rand. And actually from these 2 points, it illustrates the system more clearly on this valuation method. So on the 16th of February, we sold 4 units, right? So meaning we started off with 13 units, then we sold 4 units, as stated above, and that gives us our units on hand as 9 units left. So we had said that the inventory purchased first is what we see as sold first. So because we still had 5 units left of our original inventory purchased at 5,000, at 1,000, this 4 units sold would also be valued at 1,000. So at the end of our period, we would only have 1 unit left of the original 10. So we had 10 units which we purchased. We sold 5, then we sold 4. So we sold 9 in total. We had 10 originally purchased, meaning we would have 1 left at our original purchase price, and then we have 8 left at the new purchase price. Then we had another sale of 7 units. So we had an opening amount of 9, and we deduct 7 units which are sold, which means we would have 2 left. And where this comes in, this valuation method, is that we still had 1 unit left of the original. We had 10, we sold 5, we sold 4, we had 1 left. So our cost would be 1 unit at the original purchase price and 6 units at the secondary purchase price. So this would be our cost. And what we would have left in our account is, because we had 7 sold, but 1 of that related to our first inventory, so 6 related to our second inventory purchase, and our amount left at year-end would be 2 of the second inventory purchase amount. And then at the end, we have another purchases of 1,200 Rand per unit per water pipe. So our third purchases were 4 units at 1,200. Right? And the units on hand, when we closed off our previous period, we actually had 2 units still on hand, and now we have additional 4 units purchased, right? So 4 units purchased plus the 2, so we would have 6 units at year end, but the cost of these 4 units purchased is the 4 units at our third purchase price. And so the total inventory on hand at year end is 2 units of this inventory and 4 units of this inventory. So we would have 6 units, but at these 2 different prices, giving us the 7,000. Then the journal entries during the year for the perpetual inventory system are as follows. So a business keeps a perpetual record of inventory, and additional inventories are acquired. The inventory account is continuously updated. So this is the main difference between the periodic system and the perpetual. So each time there's a purchase or a sale, the inventory account is updated. When the periodic system is in place, the inventory is purchased and the purchases account is used, and then the receipt for the and used to record the receipt of inventory. And as such, an adjustment must be done at year end to calculate the cost of sales. That is what we did in this scenario. We used the purchases account and we do all of our adjustments at year end to get our cost of sales amount. Whereas it's different for the perpetual inventory system, we are updating our inventory account all the time. So in terms of the perpetual inventory system, at the end of the year, the cost of sales and the inventories do not have to be adjusted, as this has been done before. So to be technical, or just to get back to our question from our first lecture, should, for example, there be a stock take done and that difference from the amount on the system, yes, then adjustments could be done, but that is an out of ordinary if there was a loss or a sale or a leakage. But in general, your inventory account always shows the correct amount in the perpetual inventory system. So the accounting entries associated with the perpetual inventory system can be summarized as follows. So the bookkeeper must show that inventory has been received by the business. The business has spent money on an item that will form part of the goods on hand. Since inventory is an asset, the principles pertaining to asset will apply. And this is similar to what we did here. They are saying inventory is an asset, so it increases on the debit side and it decreases on the credit side. So whenever you purchase inventory in the perpetual inventory system, you'll be increasing, debiting your inventory account. Cash has decreased when we purchase any inventory, so that will decrease your cash, which is the same as here. The double entry principles, T accounts don't change. The cash, if you purchase any inventory, you're decreasing your cash amount. But we'll get to an example now. And inventory asset has increased and will be debited. Remember that assets increase on the debit side, and the opposite entry is the bank account. So and it will be credited as it decreases on the credit side. So it's basically just saying everything that we've done in the previous example, but just in a step-by-step formula. We'll also be looking at the markup on cost, and then we can get to some examples. I'm just showing you where we'll get to, which will show the difference between both systems and explain the perpetual inventory system. So just trying to show you what we are trying to get through, which will hopefully help your understanding. So hence, unless there's something very pressing, I would like us just to try and continue and perhaps answer the questions with the examples, and then hopefully have a little bit of time left at the end for questions, because we only have about 12 minutes left in the session. So to get back to the markup on the cost, we would have the equation for the markup on cost is basically your cost of sales is your cost price of inventory that you were sold during a period, and you have your selling price, and that's what your inventory is sold for. So to get your markup or your profit, which another lady already actually touched on in our first session, is you would have your selling price and see what your cost price is, and the difference is your profit. And how you would then determine what your markup is if your selling price, your cost price is always 100, then whatever you add to that in terms of percentage gives you your markup. But there's also an example here. So to calculate the cost price when the markup percentage is 20% and the selling price is 12,000, this is your example. This is your formula that you will always use. Your cost price is equal to your selling price, whatever you sold it for, times 100, right? Because that's your cost price, divided by whatever your cost price is, your 100, plus your markup percentage. So in this instance, you would say to calculate your cost price, you would take your selling price, which is given in the scenario, times it by 100. 100 is always your cost price, divided by your cost price plus your markup percentage. Another way to remember this is to get whatever you want on the side, be it, in this case, it's cost price. You would say, you would take what you have, right? They've given you your selling price, and you know that your selling price, what you want to achieve is your cost price. So you would put your, you would always say you have what you want at the top over what you have. I'm not sure if that will help you guys, but we can also look at the example now. So we want our cost price. Our cost price is always 100. We know in this one our markup is 20%. So what do we want? We want the 100, which is our cost price, divided by what is our selling price, right? So our 100 plus our markup, which is 120. And we've times that by what they've given us, our selling price. And this will give us our cost price. So to break that further down, it also gives you another example here to say that if you have your selling price of 120 and your cost price is 10,000, then your markup is 2,000, right? And a way also to remember this is to calculate the selling price when the markup is 20,000 and the cost price is 12,000. You will use the following formula. So at the top, they gave you the formula to determine cost price, and it's important for you to memorize these formulas, right? It is important to understand the concept that selling price less cost of sales gives you your profit. But if you can summarize these formulas, it will help you a lot in your assignments and exam. So the selling price equals the cost price, right? Plus the cost price times a markup percentage. And how they explain it here, our selling price equals our cost price, right? In this example, it's 12,000, and our markup percentage in this instance is 20,000. And our selling price, what we want to determine is the 14,400. So if we look at this formula, we are saying, what is our cost price? They've given our cost price of 12,000. And then they tell us that the formula is to take your cost price times your markup, right? So basically you're saying, what is our cost price times our markup? That is our profit. And if we add our profit to our selling price, that gives us, our profit to our cost of sales, that gives us our selling price. Maybe I can just show this one to you guys on an Excel, which maybe will make it a little bit easier. I don't know if it will allow me to share two screens. Let me just do it on here. Right. So just in this example, just to show you the calculation, which might help before we carry on. Okay, so it's telling us in this example, just to get the given as well. Okay, so it's telling us that our cost price is 12,000 and our markup is 20%. And our formula, as they said, is our selling price equals our cost price. And what is our cost price? It's the 12,000. Right, so our cost price is 12,000. And then we have to add our cost price times the markup percentage. So what is our cost price? It's the 12,000 times the markup percentage, which is the 20%. Oh, sorry, give me a second. Doing something wrong here. Okay, so we have our 12,000 times our 20%. I don't know why it's not allowing me to do that. Maybe I have to use a comma. It doesn't allow to show you guys, but basically it's 12,000 times 20%, right? So a percentage of 20% of 12,000 is your 2,400. And to get your selling price, you then add your 12,000 to your 2,400, which would give you your selling price at the end of being your cost price plus your markup. Then if we go back to this one to hopefully get to the example. So this example is similar to the previous one. You'll see the amounts are the same, but it adds markup percentage at the bottom. And it also, it has the same opening balance, the same purchases for cash, same purchases for credit, and then it has your selling price on cash and on credit. So here it explains where a perpetual inventory system is used and the inventories are purchased. The journal entries to record the inventory purchased during the year are as follows. So I think to make it easy, I can do it again here, but we can call this one the perpetual one. And then we can delete these here. And go back to what is given to us. So this is the information that they give us. Okay, so this is our given information for the perpetual, which is similar to the periodic. Other than the periodic, we didn't have a markup on inventory, and in the periodic, we didn't adjust our inventory account as we go along. Okay, so it's telling us what our journal entries are, right? So it's saying that at the beginning, so some of these entries are the same. Let me delete these entries. Okay, right. It's important for the perpetual inventory system, we don't use a purchases account, right? So I'll be taking out this purchases account. It's only used for the periodic system. Okay, so when we purchase, so first of all, we can start with our opening balance on inventory on hand, right? So we have our opening balance of inventory on hand of 20,000. This doesn't have a reciprocal entry because this was an opening balance brought forward from a prior year. Then we have purchases of inventory of 10,000 by the business for cash. Right, so if we then go to our inventory account, which is different to that in our periodic system. In our periodic system, we didn't touch this inventory account as we went along with the purchases. We added the purchases that we did in our purchases account. So in this instance, we have our cash purchases for this 10,000, right? This came in for 10,000, and this was other zero. This was on the 30th of April. 10,000, and then we have the contra account of this, right? Because it's a cash purchase, our cash needs to decrease. Our inventory increased, and our cash needs to decrease. So on the 30th of April, we also decreased our cash, and the contra account was inventory. So why did we decrease our cash? Because we purchased inventory of 10,000. Then we also had another purchase of inventory for 15,000, but this was in cash. It was done on credit. So on the 30th of May, again, we increase our inventory because for the perpetual one, we increase and update our inventory account as we go along. So this was a trade payable because we didn't pay for this cash right now. We will pay for it cash later. But it's still a liability for us. We still need to pay it at some point in time. So the contra entry of this making the inventory more is increasing our trade and other payables because they increase on the credit side because they are a liability. It's a debt that we owe. And what is the contra of this? Why did we increase our trade and other payables account? Because we purchased inventory. Right, so those are to show you the contra accounts just for our opening inventory. What was our balance? Then we purchased some inventory for cash and we purchased some inventory on credit. Right. Then where it's a little bit different, right? So these ones I think is very much the same as what we did in the periodic system, other than where we are debiting these two purchases account in the periodic system under purchases, we were now debiting them to the inventory account. The contra accounts to cash and trade and other payables, that stayed exactly the same, right? When we purchased our inventory, we purchased that, purchased our inventory, we purchased that for cash. And when we purchased our inventory on credit, we increased our trade and other payables. So the only difference here is that we are debiting inventory, whereas in the other system, we debited purchases. Right. And then when we do sales, right? So when we sell the inventory, we have one sale in bank for 22,000. So what we would be doing there is we would be increasing our bank amount, right? So as I said before, our bank would always have a opening amount, which is not given in this scenario, but there would be an opening balance as bank is an asset. And then we would have a sales because we are increasing our cash on the debit side. Cash is an asset, and we're increasing our cash with 22,000. Sorry guys, I know it's now past. I would just like to finish this example actually, as I think it will entail a lot. But those that need to drop off, Antoinette, I don't know your availability. I have a hard stop at 12. But hopefully we can finish this example.
I have no problem. I'm still with you.
Okay. So for those that need to jump off, thank you for joining. The recording will be made available, and I wish you all the best with your studies. But for those of you that can stay, hopefully we can get through this example, which I think will aid in the understanding. Right, so when we have the sale of inventory for cash on the 31st of May, we are increasing our cash, our sales, our money on hand, and we are also increasing our sales. Right, yeah. So this contra account goes to sales because this was due to sales. Okay. And then we have, then we have another portion of that, right? Because we said as and when sales occur, we are also going to account for that in our cost of sales account as we go along. And because we said that we have a 25% markup, we would say that for each sale that we are doing, we have to determine what our cost of sales part of that is. We know what our sales amount is, so we know how much came in, but we need to determine how much it actually cost us. So if we look at this, we've got our markup is 125%, right? So if our selling amount is the 22,000, which we have at the bottom as sales, we are saying, what is our sales times what do we want? We want our cost of sales, which is always 100, divided by what do we have? We have our selling price. Selling price is always your cost of sales plus your markup. So we know it's our cost of sales plus our 25%. So our cost of sales is our selling price, which we've been given, times 100 is what do I want? I want my cost of sales amount, which is always 100, divided by what I have. I have my selling price, which is 125. So when we've got this amount, what we can do is we show that this is our cost of sales on the 31st of May. This is our cost of sales, and the contra account is inventory because it decreases our inventory, right? With our inventory sold. So this amount here is a 17,000 there. And then our contra account to that would be on this is 31 May, apologies. 31 May. So our contra account of our cost of sales is what happened. Our inventory decreased, right? When we were selling something, our inventory decreased, just as our inventory increased when we purchased something. So when we sold these goods, the 22,000 for cash, our inventory decreased, and that originated to a cost of sales. Okay. Then there's a sale of inventory on credit, right? So then we had another amount sold on credit, which was a sale, right? And that sale was on the 31st of October. But this wasn't for credit. This was for sold to trade in other receivables. So we haven't received the cash now. We will receive it later. Receivables. Okay, 26,000. Okay. And then we have our, so we increased our sales, right? Made our sales more. And the other part of that is to increase our debtors account because we will receive this money later. Our contra account to this is sales. Why did our debtors increase? Because we sold something on credit, and our sales increased because we had the sale. And similar to the previous example, we have to then determine what our cost of sales is. So again, how do we work out our cost of sales? We look at our selling price, which is the 26,000, times what do we want is 100, which is the cost price, divided by what we have is the cost price plus the markup. So our cost of sales for the second tranche of sales is 20,800. So this would, as in the similar example, we would decrease our inventory with that cost, right? Because we sold the inventory, making our inventory balance less. And then why did our cost of sales increase? Because we sold inventory. So this would be our contra account. This would be 31 October. Okay. So basically in your inventory account, what you would have is you have your opening balance, you add all your purchases, you deduct all your sales, the cost of sales of that, and then your closing balance at year end is what's left on your inventory account. In your trade and other payables account, you would have whatever you bought on credit. So in this instance, we purchased inventory of 15,000 on credit. And then in your bank account, you would have your opening balance, whatever that is. It would be increased with your sales for the period and decreased with whatever amount of purchases you did using cash. In your sales account, you would always add all sales for the year, be it cash or on credit. And in your cost of sales account, for each and every sale, you would expect there to be an entry in the cost of sales account, but that would not be at the same amount of your sale, but at the amount of what it actually cost you. And then your trade and other receivables account, this would be the amount that you have sold on credit. So this would link to your sales account and not be the cash portion, but the portion that you did on credit. So is there any questions after that one? Because I think it entails quite a lot, of all the concepts, and we won't have chance to go through probably the next example. Is there something that I discussed there that doesn't make sense or you would like me to reiterate?
Lynn-Marie, there's one hand, C. Stewart.
Hi, ma'am.
Yes,
I
hi.
just wanted to ask about how ma'am got the 20,800.
This one here. Yes, the cost of sales. Was the
Yes.
17,600 clear to you?
Yes, it was clear to me.
Okay, so it's the same formula, right? And if we also look at the study guide, we'll see that our formula for counting our cost of sales, if we just go back to that here, and our formula for looking at cost of sales is always right. You want cost of sales, but they're giving you the selling price in this instance. Let me just add you both of these formulas just to make it maybe a little bit better. Okay. So these are normal equations. If you've got an unknown, then you have to look at where that comes from. But if we look at these two equations, we can see that cost price equals selling price times 100, which is normally our cost price percentage, divided by whatever our cost is plus our markup percentage. So in this example, they told us that our markup percentage is 25%. So if we fill in the blanks there, meaning we want to work out what's our cost price, we have to use our selling price, which we have is the 26,000, right? And that 26,000 we multiply by 100, which is our cost, right? Our cost is always at 100, and we divide it by the cost plus the markup. So 100 plus the 25 is 125. That gives you your 20,800. The way that I like to remember it is to say, you take what they've given you, in this case, your selling price, 26,000, right? I'm just going to do it here. And then you multiply that by what do you want? You want your cost price. Your cost price is always 100 over what do you have? Your selling price is your cost price plus your markup. So you've got 125, and that gives you your cost price. Does that help?
The 17,600 is the cost price of the 22,000.
Correct.
And
Again, we
the
take ours.
20,800 is the 26,000.
Yes.
Okay, thank you so much, ma'am. I understand now.
You're welcome. Any other questions?
There's one hand that's been up
tell him.
the whole time, but okay, there she's speaking now.
Yes, I still have my question regarding the cost of sales, which is why I had my hand up and I said as we go to the unit, I'll ask
go ahead.
questions. Yes, but we haven't finished the unit, so I don't know whether
You can ask the
should
question
I
now
wait until
because they
maybe we
won't.
finish?
No, because I think our time is running out extremely fast. So ask the question and I could try answer that for you based on what we've done or what we still need to
Okay,
do.
and okay, because I don't know if it would confuse maybe the future students watching the recording or something, but I'll still ask.
Yeah, you can ask and just refer to where it's in
Okay,
the study guide,
so
and I will project that.
okay, so with this example 3.0 that you currently have up, the transactions are exactly the same with the periodic system that was in example 3.1 on page 10.
The transactions are the same. Yes.
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 Yes, but this one, because it is the perpetual, we had markup indicated, and we had a different markup than the periodic inventory system.
Yeah, the periodic inventory system, we don't have a markup at all. That one, how we calculate our
Yes.
cost of sales is based on this formula. Yes.
Okay. Okay. So just asking, because with these two examples, it just so happened that the cost of sales was different. But let's say if it was exactly maybe the same transaction and it was just to display the different systems, would the cost of sales still be the same for both companies
No.
or both examples?
Are you saying if the markup was the same for both and they purchased it for the same price?
Yes.
In an ideal world,
Yes.
yes. Yes, in an
Okay.
ideal world, yes. But what's
Okay.
important for you to remember is that for the periodic inventory system, you are not adjusting your inventory account as you go along. You are adjusting your purchases account and you are taking everything to cost of sales. Whilst when you do your stock take, that's your final trigger to determine what your cost of sales is. However, with the perpetual inventory system, you are calculating your cost of sales as you go along, as you know what your markup is. So you're already working out what your cost of sales is as you go along. Whereas with the periodic one, that's not the case. But yes, in an
Okay.
ideal world, you would then expect it to be the same 5,000 Rand cost of sales.
Okay. And then my other question is regarding example 3.4, specifically page 18 on our study guide.
3.4, page 18. This one?
Yes.
Yep.
Yes.
Yeah, go ahead.
Okay, I can't see it, but I presume I'll
Okay.
see it up because my network is slow.
Okay.
Okay, yes, now I can see it. My network. Okay. So with this example, when we were closing off at the end of the month and we were moving our purchases and our to our inventory account to determine cost of sales, we we conducted the process differently as compared to example 3.1 on page 10.
Okay, and let me just quickly, for the benefit, try go through it, right? So
Hello?
it said, yes, can you hear me? Is it just one person that can't
Yes,
hear
yes,
me,
yes.
or you can hear me? Okay. So on
No,
the
I
first
was
of,
no, it was just fine.
okay, so just to reiterate this example, on the 1st of May, a business purchased 1,000 units of inventory, right, at 120 units on credit. This purchases will be recorded as follows. So we are debiting our inventory account, but this is the perpetual inventory system, right? So this is showing you the differences between the two inventory systems, just for everybody's benefit. So we would be increasing our inventory account as we debit and credit our inventory account real time with the perpetual inventory system based on the number of units purchased times the amount, right? So our inventory amount increased with 120,000, and our trade and other payables, because this was a credit, would increase with the same amount. For the periodic inventory system, the entry is exactly the same, other than you don't use your inventory account, but you use the purchases account. Then we have that these units were sold, 350 units of inventory for 200 Rand per unit on credit, right? So again, our perpetual inventory system, our sales is our 350 units times our 200, increasing our sales, increasing our debtors, and our cost of sales is our 350 times our 120, right? So we said, okay, our purchase amount was, our cost was 120, so 350 times 120, that gives us our cost of inventory sold, and we also decrease our inventory account. Whereas on the periodic one, again, the first part is the same. Our debtors increase with the amount of sales, and our sales increase. But where it's different is under the periodic system, this is the journal recorded, right? So we have inventory at hand on year end is 78,000, and this would have been done by a stock count, right? And that would have gone to purchases. So the quantity of units on hand at year end would be 1,000 units purchased minus so many sold, gives us 750 units. And the cost of inventory at hand is 750 times 120, giving us the 78,000. And how this is different, just because I'm trying not to be too fast, but also being cognizant of our time, is what we did in the periodic system. We said it's purchases, right, and minus what you sold, gives you your units left, what you would actually do at the inventory count, right? And that is how we have our closing inventory amount. Then we have cost of inventory on hand at the end of the financial period, right, is again the same, transfer to total purchases to the cost of sales account, and the cost of inventory is total purchases minus closing inventory, and that gives us what we have left, our cost of sales amount in the periodic inventory system. But I think your question more relates to the 3.5, which follows up on that, right?
No, my question, you've gone through it, yes.
Okay.
So
here's where you're saying.
Yes, this page, yes.
Okay.
Okay, so my question is, my question is, I don't know if you could remember on 3.1, page 10, how we concluded our purchase account and calculated our cost of sales.
Yeah, which is this example. Hopefully you can see it for the periodic, right?
Yes. I still remember it. I went through the study guide. I just
so if we go back, yes.
Okay.
So this one says
so,
that under the period. Yeah, go ahead. Maybe our networks are crossing.
Okay. So my with this one, the conclusion of the purchases account is different because we did not take the total purchases and put into the cost of sales, and we did not take the opening if there were to be a T account for these, because these are the journals, right? So if there were to be a T account, it would show that the total purchases are not being put into the cost of sales, and the inventory on hand are not being put onto the cost of sales. I'm not sure if you follow, because I'm just asking to a visualization of what is happening. Because with this one, it's expressed as journals, but with the other one, it was expressed as T accounts.
Yeah, let's see what we can do for this example. Okay.
No, I'm not asking you to draw out the T accounts. I'm just saying.
But I think you're trying to see it in T accounts to understand the difference, right?
No, I understand.
To explain it. Okay.
No. My question is, we did something. I can visualize the T accounts.
Yeah.
I understand the journal. I understand what is being done. I'm just saying, yes. I'm just saying the purchases in this case, which is was split, the total purchases being put under the cost of sales. They have not been put on the cost of sales. They've been split. The purchases still on hand are now put into the into the inventory account, and the purchases that have been sold off is now in our cost of inventory sold.
Okay.
Am I?
Yes, I think I understand what you're getting at. And I think this question is a little bit different from the other one in the fact that we know what the units cost in this question, right? And we know how many units are on hand and their cost price. Whereas in the first example, there was no mention of how many units you purchased, at what amount you purchased it. It literally only said purchases of X amount was done, right? So for example, if we look here, the purchases of 10, purchases of 15,000. So what this one is doing is taking us back to that same example, saying, what is our cost of inventory sold, right? But it's getting to that answer in a different way, because we have the cost of units sold. Although we get to the same answer, I get what you're saying. It's a little bit confusing to understand how the two work together. But if you do have the cost price per unit and you've got the number of units, then this is how you would work out your cost of inventory sold, if that makes sense.
Okay, no, that's
Maybe
fine. But I just wanted.
yeah, maybe you can. I understand it's a little bit different, because in here we had the units and the amounts, whereas in the first one it was just very, I can say, simplified. Whereas this one has got a bit more beef to it. But indeed, when you've got the amount per unit, this is the way that you would do it. But if you just have the amounts in total without the units and the unit cost, then you would be doing it the different, as we did in the previous example.
Okay. No, I just okay. With the other one, I'm just asking because I prefer this one on 3.4, because with the other one, we're putting cost of sales, we're putting like inventory in cost of sales, which is on hand. Even though we do not have the unit, we still have the cost. We still have the inventory on hand, the purchases, yeah, because I'm not going to say inventory, the purchases, the amount, yes.
Yeah.
So we could have taken the total as with the equation that was, because in page 10 there's like a schematic diagram that shows. So I was saying we could have taken the total purchases, subtracted the inventory on hand, and then divided it accordingly without having to put inventory in cost of sales, which were not incurred in cost of sales. So that's where I'm like, and also when I'm doing maybe a question paper, because of the way our multiple choice questions are set up, if I'm what to, like, how would I navigate if I were to do this, because there's two separate ways. So yes, with this one, yes, we could, because the question told us that we have our purchases and our inventory without having the units. We could have just added the purchases and the opening inventory, got our 45,000, then subtracted the inventory in hand. That way we still would have gotten which we would have put into cost of sales, just as we did with 3.4. So
I can't seem to hear you anymore. But in a nutshell, I agree that your answer would be the same. It's just that this example was done to give everybody, a step-by-step example of how to get to the answers in a schematic way using all T accounts.
Ma'am, hi
Yes.
ma'am.
Hi.
Is it possible for you to share that Excel in the chats with us, please?
Yeah, sure. I can drag and drop it. Everybody should, I think, have access to that then. I will save it now and then drag and drop it in the chat. Anything else? No?
No, it doesn't seem there's any hands. Then, Maria, I just want to thank you on behalf of the students and everyone. Just thank you for your time and for all your trouble. And we really appreciate it. And the hearts is coming up again and clapping of hands. So I think you did very well. Students, I also posted the evaluation form. If you can kindly please complete it, and I will make sure, and I will try my best to make sure that the recording is available either tomorrow or, yeah, hopefully tomorrow. I would like to have it already ready for this afternoon, but unfortunately I don't have the access to upload it. I must ask someone else, so let's hope they can assist. I see there's one more hand. Can we quickly take that?
Sure.
We're running out of time. Zake? You can go ahead. Go ahead, sorry.
Just wanted to find out if the class continues at 5 today in the afternoon.
No, this clause was regarding the depreciation for, the inventory. We didn't manage to get to depreciation, but you can listen to previous recordings from some of the other regional offices that you can also listen to regarding that. Tonight's class will be at 1900 hours. Just check your announcement. It will be regarding your VAT and bank reconciliation.
Antoinette, maybe just a question. I can't drag and drop anything in the chat. So maybe I can just send you the Excels.
Yes, and I will try and see if I can upload it, or I will see if I can also post it in the notes or something.
Thank you.
Thank you, Lynn Marie.
Thank you
Thank
too.
you.
And have a good rest of your day, everybody.
Yes, goodbye.
Okay. Bye.
Bye, ma'am.
Bye.
Yes.
Yeah, I wanted to find out, is Antoinette still in?
Yes, I'm in.
Oh, okay. Does Lynn Marie have a WhatsApp group, and who will be conducting the class for 7 o'clock?
No, she doesn't have a WhatsApp group, but it depends on which e-tutor group you were allocated to. I'm not sure what's her e-tutor group number, but you're welcome to send a post on your own e-tutor group.
Okay.
Tonight's class will be presented by one of the other lecturers that's assisting me, Dr. Annelien van Rooyen. So, yes, let's see how it goes. Yeah, it's the first time she will be presenting for the semester.
Okay. Thank you so much for getting different people to teach us. I think there was a gentleman on Thursday. He was also very good. It's been very helpful.
Oh, it's a pleasure. I'm really glad you guys are benefiting from this. We're just very late with everything, unfortunately, due to contract problems from people to be appointed and so forth. But if hopefully we can finalize today's schedule, I'll post that also as an announcement so that you guys can plan ahead, to decide which class you want to attend and so forth. But thank you again. I appreciate that a lot. You guys must have a blessed day further. I unfortunately have to run to another meeting.
Thank you.
Thank you. Bye, guys.
Thank you. Thank you, ma'am. Bye.
Ciao.